Hi everyone. So welcome to the stream today. Very much excited for having you on our next meeting on the Executive Revision Masterclass, focusing on the consolidated financial statement for those of you writing financial reporting, corporate reporting, and then advanced financial reporting in relation to that. Now, this is a topic that is very fundamental and critical for students writing their ACCA exams, their ICA exams, their CIMA, CPA and CFA exams. All of these examination have key areas about consolidated financial statements that is critical that you must understand in relation to that. So yesterday we looked at an introduction to the consolidation, discussed a couple of principles about consolidation, and look at the various things. And we started with the core principles, and we look at the issue in relation to determination of the group structure. Then we discussed the issue about investment in associate, how we account for it in accordance with IAS 8. Yes, IAS 28, investment in associate using the equity method. And then also we delve into the details about the various things we need to when it comes to the issue about hi, hello. Yeah. So we dealt with the issues in relation to an entity, which entity that can prepare the consolidated financial statement. How do we determine control? How do we determine significant influence, and all of that? We discussed all of that in relation to that. Okay, so I see Mustafa coming in, Emmanuel Addison coming in, Ebenezer Alta coming in, also Enoch Tamaklo, Andrew Opon Beko, hello. I believe you are doing well. Give us a thumbs up on the video. That way we get more engagement on the video and we'll be able to reach as much people as possible because YouTube will be pushing the video out in relation to that. Is my sound okay in the chat box? Is my sound okay? Let me know in the chat box if my sound is okay. Richard Opoku Ajiman, I see you. Give us a thumbs up on the main video page as well. The main video page, not just in the chat box, but the main video page. That way we get more engagement on it. Kletos, I see you. You are welcome. So give us a thumbs up on the main video page. That way we get more engagement on our video and we'll be able to reach many people because YouTube will be pushing the video up. Okay, Cletus said the sound is okay. Thank you very much. So we want to continue with the issue in relation to consolidated financial statement. Andrew Sopoku said sound is clear. All right. Richard Opoku said it's okay. Ebenezer said, please, when will you check the solution I sent to you on WhatsApp? Okay. John Edu said, good afternoon, sir. Yeah, good afternoon, John. Ebenezer, your solution will be looked at and then will be replied to you. So that will be handled on WhatsApp for you. Right, John, you are welcome. So welcome everybody. Give us a thumbs up on the video, okay? Give us a thumbs up on the main video page so that way we get more engagement on the video. Thank you guys. Jonas, you are welcome as well. Thank you for joining the stream. If you know there is somebody that must watch the video who is not here, share the video with them on your WhatsApp pages, on your Telegram platforms, on your Facebook groups, so that we get many people joining the stream as much as possible. All right. So share the video as well if you know you have some colleagues that must join. All right. So let's go into the day's business. And like I mentioned yesterday, we started with the consolidated financial statement, and I started with the principles on how we can prepare the consolidated statement of profit or loss, or the consolidated statement of financial position, and dealing with the issue about how we determine the group structure. We looked at the investment in associates in accordance with IAS 28 using the equity method. And then we looked at the issue about the net asset of the subsidiary and the various items that actually constitute the net asset of the subsidiary in relation to that. If you have any questions, you know what to do. Put it in the chat box. I'm reading all of your comments and I'll be replying to them. So if you have any questions on something we covered yesterday or any other thing relating to what we are doing or in whatever field, I could look at it and then answer you in relation to that. Richard Amegashi, I see you. You are welcome. Share the video if you can. Give us a thumbs up on the main video page. Also, that way it helps us to grow the channel as fast as possible. Right. So number one, we looked at the group structure yesterday, and we saw how the group structure can be determined for a simple group, level 2 financial reporting, and then a complex group for level 3 corporate reporting or advanced financial management. Then along with the group structure, I dealt with how we treat with the investment in associates. And we said that we use the equity method, and Bernard Kwabena mentioned that as well in the chat box. I don't know, maybe today Bernard is not in yet. And then the third thing we looked at was the net asset of the subsidiary, and we saw the various adjustments on fair value adjustment, depreciation on the fair value adjustment, the fair value adjustment above and below, dealing with the issue about the intragroup trading when there's subsidiary sells to the parent. I told you that when there is anything like that, subsidiary selling to the parent, then provision for unrealized profit would have to be computed on any inventory of the goods bought by the parent from the subsidiary, which are still in stock, so that that will come to the year end for the net asset of the subsidiary in the determination of the post-acquisition profit. So from the net asset, I mentioned that, and we concluded that the net asset at the date of acquisition will be used in the computation of our goodwill. And then we mentioned that the difference between the net asset at acquisition and the net asset at the reporting date becomes the post-acquisition profit or loss, which will be used in the computation of the group retained earnings or the consolidated retained earnings, as well as the valuation of the non-controlling interest at the reporting date in relation to that. So these are a couple of things we mentioned yesterday about the core principles in relation to the preparation of the consolidated financial statement. So Xavier Ahido, I see you. You are welcome. Richard Opoko Ejiman said, please, can you go over how to account for associates? All right. So we mentioned that when it comes to investment in associates, we account for it in accordance with IAS 28, that is investment in associates, and using the equity method, right? So under that, we're going to be bringing the cost of the investment, how much we paid to acquire the associate, or we invest in the associate. Then we bring post-acquisition profit or loss. Post-acquisition profit or loss. We said when it is a profit, you add If it is a loss, we deduct it in relation to that. Then I told you that there could be impairment in our investment in our associate, not impairment in goodwill. So if, for instance, the company that we have invested into experience a loss, and it affects the investment, it affects the share value, and our share price falls, that impairment will have to be deducted. Then we said any dividend that we receive during the year from the associate will also be deducted in relation to that, right? So these are the things that we mentioned, and this is what gives us the closing balance or the carrying amount of the investment in associate, which will go to the group statement of financial position under non-current assets. But we mentioned that this post-acquisition profit or loss will go to the group retained earnings. If it is a profit, we add it. If it is a loss, we subtract it. And then the impairment will also go to the group retained earnings or the consolidated retained earnings. And that will also be deducted in relation to that. So that is how we deal with the investment in associate. So Richard Opoku Ajeman, are you okay? Any other questions, you can put it in the chat box. I'm going to be answering all your questions for you. Let me know if you have any other questions. Okay, so Richard Opoku said, give us a thumbs up, so it means you're okay. So the next thing we want to look at, so we look at the group structure, we look at investment in associate, we look at net assets of the subsidiary. So the third thing we want to look at is the calculation of goodwill. Remember, I mentioned that goodwill calculation is always a reserved thing that the examiner will bring or will ask you to do. And almost all the time there is a 4 or 5 mark question reserved for the computation of goodwill. So it's very, very important to know how to compute the goodwill. Now, so what do? We bring our currency sign, we bring the percentage of ownership, then we look at the fair value of consideration transferred. Fair value of consideration transfer, taking into consideration the percentage of ownership. So let's say we own 80%, okay? Then we bring fair value of NCI at the date of acquisition. That is non-controlling interest at the date of acquisition. We add it up, and that gives us the fair value of the business. So once we have the fair value of the business, we now bring the net asset at the date of acquisition. And realize that. Then the figure we get is goodwill, all right? It's goodwill. However, sometimes there could be impairment in goodwill. So where there is impairment in goodwill, we are going to be subtracting it. So sometimes there could be impairment, and that could be deducted. And the net figure we get becomes the goodwill figure, and that will go to the statement of financial position. Remember, we said the investment of the parent in the subsidiary is replaced on the face of the consolidated financial statement with the goodwill, all right, with the goodwill. So that is the issue in relation to that. Then I see another comment coming from Richard Opoku. He said, please, can you have a question where you will be asked to use both fair value and proportion method in calculating goodwill? No, it's only one of them that will be there. The two cannot be used in relation to that. And I'll be going through these things for you in a moment. Now, the fact that this is how goodwill is computed does not mean this is how we're going to be going through it in relation to that. So what is actually going to be happening is that, number one, we may do workings for the consideration transferred. And then number two, we may do workings for the fair value of the non-controlling interest. So the question we ask ourselves is, how do we calculate the fair value of consideration transferred? What constitutes the consideration transferred? And then how do we value the non-controlling interest in relation to that? That is what we want to look out for here as the workings for our goodwill. Remember the net asset, we've already done that from the workings 2, where we did the net asset of the subsidiary in relation to that. Jonas said, you will talk a little bit on joint ventures consolidated approach. Okay. Are you asking me to talk about it, or I'll talk about joint ventures certainly as part of the principles. So let's go through the workings and then let's find out how we can determine the fair value of consideration transferred. So workings, all right. Fair value of consideration transferred. So if we want to get the fair value of consideration transferred, that is how much the parent is actually incurring for the acquisition of the subsidiary. How do we go through that? Please note that the fair value of consideration transferred could contain four components. The first one is cash consideration. Cash consideration. This is simple. This is where the examiner could say that, okay, on the date of acquisition, the company paid $1.5 per share acquired. Okay, so you just multiply 1.5 by the number of shares that the parent acquired in the subsidiary. You get your cash consideration. So immediately, right now, at the date of acquisition, how much did we pay? That is the first component of the fair value of consideration transferred. But not only will a company or may a company pay cash, there are sometimes a company acquires another company and they don't pay anything immediately, they deferred the payment. So the second component of the fair value of consideration transferred is what is called deferred payment. Deferred payment. Now with a deferred payment, this is where you are going to be making the payment somewhere in the future. It could be a year from the date of acquisition, or it could be 2 years from the date of acquisition. Whatever it is, we are going to be calculating the present value of that future payment. And that is what we bring here in the determination of the fair value of consideration transfer. Tamba Brahma said, oh my God, I'm late. You're not too late. We have not delved a bit deeper, so you will still be able to follow us. So the second component is the deferred payment. So what do we mean? We acquired a company now, but we are going to be making some payments in 2 years' time. So if we are going to pay some payments 2 years' time, we will discount that cash flow into present terms. Okay, we discount that cash flows into present terms using the cost of capital of the parent. Please listen to this carefully. Using the cost of capital of the parent company, we discount the cash flow to present terms in relation to that. Always note that anytime in the question there is a deferred payment, we need to calculate finance cost on it. Did you hear that? Anytime there is a deferred payment and we discount it to present value, or in the question the examiner gives us the present value, we must unwind it and calculate the interest component on it, which will be going to the group retained earnings. So take note of that very well. That unwinding will be debited to the group retained earnings and credited to the deferred payment account on the face of the consolidated financial position in relation to that. So make sure you take care of that. So first one, cash consideration, how much we paid immediately for the business. The second one is deferred payment, how much we're going to be paying in the future, which is always discounted into present terms. After you discount it into present term, you have to always put this in your mind. It's about principles. So when you see the item in the question, you know exactly what you are going to be doing. So once there is a deferred payment and you calculate the present value, don't forget, you compute the finance cost on that, and that will go to the group retained earnings and will also be added to the amount of the deferred payment in relation to that. So that is the second, that's the second component of the fair value of consideration transfer. Next one, it's one of my favorite, and that is share exchange. Share exchange. Now, the idea about share exchange is this. There are times when the company that is acquiring the other company, they want to provide a continuing interest to the shareholders of the subsidiary companies. Because remember, if we give them money today, they don't have any control, any interest again in the company we've acquired. If we promise to pay them in the future also, they still will lose their interest in the company in relation to that. But sometimes in order to facilitate the acquisition easily and make shareholders feel that, oh, they've not really sold their company, then another way we can finance it is through what is called share exchange. Now, this is what I want you to be careful about. This is what I want you to be careful about. You could see that there are a couple of things. I take my time to talk to you about it very well because I know you're going to be facing it in the exam hall and it's going to be playing trick on you. So make sure you understand it very well. When there is a share exchange, it means that the parent company will issue new shares in proportion of the number of shares acquired in the subsidiary company. Let me take that again. When there is a share exchange, it means the parent company is issuing new shares to the shareholders of the subsidiary company in proportion of the number of shares that has been acquired, which simply means that if we want to get the value of the share exchange, we look at the number of the shares that we have acquired, we determine the number of the share issues that we have made due to the proportion, and then we multiply it by the share price per share of the parent. So we always value share exchange using the parent's share price. Does it make sense? So make sure you understand this carefully. Now, note also, anytime there is a share exchange, it means that the number of equity shares of the parent company will go up. And chances are they may issue the shares above the nominal value. So it means this share exchange must be splitted into the share capital and the share premium. You know traditionally that if you are preparing the consolidated statement of financial position, we bring the share capital of the parent company. That's what we do. But when there is a share exchange, we bring that share capital plus the stated capital or the share capital in the share exchange in relation to that. I believe you get that principle very well. So first one, cash consideration. Second one, deferred payment. Third one, share exchange. All of these will be included or may be included in arriving at the fair value of consideration transferred. Now, the reason why I emphasized here that the share price of the parent is used to value the share exchange is that when we get to NCI, there is a way, one of the methods to value NCI, and that is using the share price. But when we are valuing the NCI, we use the share price of the subsidiary to value NCI. But when we are valuing share exchange, we use the share price of the parent company, because in share exchange, it is the parent who is issuing shares to the shareholders of the subsidiary in proportion of the number of shares acquired in the subsidiary. The fourth thing to talk about is the issue in relation to issue of loan notes. Issue of loan notes. Now, you see, sometimes the shareholders of the parent company may disagree a share exchange. The reason is that a share exchange results into dilution in the earnings per share, dilution in the control of the company. Why? Because the share price, the share number of shares goes up, new shareholders are coming in. So sometimes the shareholders of the parent company may resist the acquisition if it is going to be financed through share exchange. Rather, they will propose that we should finance the issue using what is referred to as the loan notes. Because when we issue loan notes, what happens is that the shareholders of the subsidiary companies will not be shareholders of the parent company. Rather, they will become creditors, and we will deal with them and treat them as creditors in relation to that. Then you must note that anytime there is issue of loan notes, there has to be interest on the loan note. So that interest on the loan note will also be computed and will be taken to the group retained earnings. Please get this very well. Assuming we are preparing the statement of profit or loss, that is the consolidated statement of profit or loss, then the interest on this loan notes that has been issued at the date of acquisition as part of the consideration transferred will be added to the finance cost in the statement of profit or loss and other comprehensive income. I see some comments from Addison and John. Let me look at that. Emmanuel Addison said, please, sometimes we can have contingent consideration instead of deferred payment. Contingent consideration is just the same as deferred payment, because contingent consideration simply means that we are going to be making some payments in the future depending on a certain condition. So maybe your profitability will increase, then we'll make this payment. So contingent consideration has the same behavior, just like deferred payment in relation to that. So Emmanuel, that is one thing that you have to understand in relation to that. Then Emmanuel said again, and can there be a question with all the forms of consideration? Yes, there could be a question like that with all the forms of consideration in relation to that. So you must know how to do the treatment for them. If you go and it's only one, you go away. If it's only one or two, you deal with the treatment. Then John Edu said, sir, the share split again, please, the share premium. Okay. So what I mentioned was that where there is a share issue, the company will issue the shares at its share price, its current share price. So if its current share price is, say, $2.5 per share, and the nominal value of the share is $1, it means that this 2.5 must be divided into the share capital and then the share premium. The $1 goes to the share capital, and then the 1.5, the profits they are making, goes to the share premium in relation to that. So that is how we do the split on the share exchange in relation to that. John Edu, are you okay? Emmanuel Addison, are you okay with the treatment? If you are watching, give us a thumbs up on the video. That way we get more engagement on it, and YouTube will be able to push it. So it will be able to reach a lot of students just like you. So we can really help a lot of people on the platform in relation to that. Then if you can also, you share the video with your friends, your colleagues, and their loved ones on your WhatsApp, your Telegram, and your Facebook chats, so that we can, Facebook groups, so that we can reach many people as much as possible. John Edu and Emmanuel Addison, are you okay with your questions you asked me? Okay, so John, okay, Emmanuel said, thanks, sir. Right, you're welcome. Okay, John Edu also said, okay, all right, that's good. So now, when we sum all these up, that is what gives us the fair value of consideration transferred. So this is how we get the consideration transferred. So when we say calculate goodwill, fair value of consideration transferred, you don't just get up and go and put the fair value of consideration transferred. Usually from the preamble of the question, you can get a fair value of the consideration transfer, what it includes, or sometimes it's in note 1 in relation to that. Avoka Gajesbeck, hello, I see you. Welcome to the stream. Give us a thumbs up on the video. That way we get more engagement. Thank you very much for smashing the like button for me. So this is the first one, fair value of consideration transferred. So let's move on to the second one, fair value of non-controlling interest. So how do we determine the value for the non-controlling interest? Remember I told you that previously it was called minority interest, but now it's called fair value, sorry, non-controlling interest as per IFRS 10. So let's do it. Let's go to the next workings, and that is fair value of NCI. That is non-controlling interest. So fair value of non-controlling interest at acquisition, okay? Because we will do NCI at the reporting date. So what we are doing here is the fair value at the date of acquisition. Now, when it comes to valuing the NCI or non-controlling interest, there are about 3 ways they can be computed. So when it comes to the NCI, only one of these methods I'm about explaining, that will be in the example, all right? So the first way that the non-controlling interest can be valued is at fair value by the parent. This is a direct way of valuing by the parent at acquisition. This is the direct way of valuing, or the simplest way of valuing the NCI. So with this one, it will be stated in the question that the board of directors of the parent company have deemed that the non-controlling interest at the date of acquisition should be valued at $2 million. So in that case, you don't have to think about anything. You just pick that figure, and that becomes the value of the non-controlling interest at the date of acquisition. Another way that the NCI can be valued is at fair value as fair value in relation to, as a proportion to the net asset at acquisition. Now, this one requires a workings. Fair value as a proportion of the net asset at the date of acquisition. Now, what does this mean? This is where the directors say that, all right, to be able to value the non-controlling interest at acquisition, we take it as their ownership of the net asset of the subsidiary. So here, if our non-controlling interest is 20%, then the net asset at acquisition, we take 20% of that. That becomes the fair value of NCI at the date of acquisition. Does it make sense? So that's the second way we value NCI. Remember, I told you that when it comes to NCI, one of these will be in the question, not all of them, just one of them. So you should be able to read a question and come up and know what you are supposed to do. And then the last one is what I referred to previously when we're dealing with the fair value of the consideration transfer. At fair value, using the share price. Okay, at fair value, based on the number of shares. The number of shares owned. This one also requires a workings. Now, what is the meaning of this? What's the meaning of this? This one means that if the NCI owns 2,000 shares, then we will value their shares using the share price of the subsidiary. This is what I was telling you about when we're dealing with consideration transfer. So one of these can be in the exam hall, and you have to be on the lookout for that. See some comments. Lisa Raps said, your videos are good, Nhyira. Please keep it up. Thank you, Lisa. Andrew Oponbeko said, please, again. Andrew, again on what? What do you want me to repeat? Any questions, please, on how we value the NCI? Remember, I said each of these will be different. Okay, so only one of these methods will be in the exam hall. Either we are looking at it, the first one requires no workings directly in the question. The second one is the proportion of the net asset. It requires a workings. So the percentage of NCI multiplied by the net asset of the subsidiary at the date of acquisition, that gives us the fair value of NCI at acquisition, or based on the number of shares that the NCI owns. Then in that case, what is going to be happening is that we are going to look at the number of shares they own multiplied by the share price of the subsidiary in relation to that. Andrew, upon Beko, what did you say I should go over again, or are you okay? Please indicate and let me know. Okay, Andrew said fair value proportion of net asset. Yeah, so what I'm saying there is that, let's say the NCI, so let me rub my head in. Let me help you out there. So let's say that the NCI, based on our group structure, NCI is maybe 25%. So from our net asset of our subsidiary, we realize that the net asset of the subsidiary at the date of acquisition, it's maybe 20,000. So in that case, if we are looking for the NCI value at acquisition, it will be their percentage of ownership. That is 25% multiply by 20,000. And that will give us the NCI value at the date of acquisition. So that is how we deal with the proportion of net assets. Andrew, upon Beko, are you okay? Let me know if you are okay with the explanation. And then if any of you have any questions too, you can put it in the chat box. Okay. Okay, Andrew said thanks. You're welcome. So in the computation of our goodwill, fair value of consideration transferred, we've seen how it is computed. Then we come to the next one, the issue in relation to fair value of NCI at the date of acquisition. And I said that there are three methods. The question will determine which of these three will be used. So just have an idea of them. The first one requires no workings. You just pick the figure and bring it up. The second one requires workings. The third one requires workings in relation to that. Any other questions? Put it in the chat box for me. Okay. So now that we've finished with our workings 3, that is our goodwill, we need to go to group retained earnings. We need to go to NCI. But before I go to all of these, that is the other two things, I'm going to deal with workings 4, and that is going to be intra-group trading. And I want you to pay close attention, very, very close, very close one. So let's look at it. Because there is a secret nugget there I want to share with you. So workings 4, or principle number 4, and that is intra-group trading. Okay, divide my, okay. Emmanuel Addison said, please, what if the question is silent as whether fair value or proportionate of net assets? Emmanuel, for the NCI evaluation, the question cannot be silent. All the time, the way NCI is supposed to be valued will be given in relation to that. Okay, it will be given in relation to that. Because if the question is silent, then, which is rare though, but if the question is silent, you can use the net asset method if you don't have the share price of the parent of the subsidiary company. But if you have the share price of the subsidiary company, then you can use the share price of the company to value the NCI. But if you don't have so if the examiner is quiet and you don't have share price, okay, then you can use the net assets, proportionate of net assets to value the NCI. So Emmanuel, that is what you can do in relation to that. Miriam, I see you. You are welcome. Give us a thumbs up on the main video page as well. That way we get more engagement. Now, so there is a secret here. So make sure you pay close attention. Let me drop the deal for you. Many students struggle with consolidated financial statements because of the treatment of intra-group trading. So stay with me closely here. Now, I introduced you to intra-group trading yesterday when we were dealing with the issue in relation to the net assets of the subsidiary, talking about provision for unrealized profit. So we want to escalate that a little bit. So the parent and the subsidiary. Now, two things can happen here. Number one, either the parent is going to sell to the subsidiary or the subsidiary is going to sell to the parent. And I'm going to use one of them to set it out. Anytime there is intragroup trading, the principle is that the total sales, listen to this carefully. So if you're preparing the consolidated statement of profit or loss, the total sales must be canceled out. Now, when we say the total sales must be canceled out, now when we say total sales, we are referring to the total sales in the post-acquisition period, right? So if the parent sold to the subsidiary an amount of, say, $30,000 or $30 million, that total sales is what I'm talking about here. For that total sales, it must be reversed. How do we reverse that? We take it from the revenue and take it from the cost of sales as well. So the double entry will be, we debit the revenue. It means we deduct it from the revenue, the total sales, and then we credit cost of sales in relation to that. So that is how we deal with the total sales. This is if we are preparing the consolidated statement of profit or loss. Are you following me? That's the first thing we do. But as always, when there is intragroup trading, there could be something fishy in there. The first one is that there could be some of the goods outstanding at the end of the year or the reporting day. So if the goods are outstanding at the reporting date, so some of the unsold goods are there at the reporting date, then we have to calculate the provision for unrealized profit. Why? Because if I sold to you and you are my subsidiary and I've sold to you and you have not finished selling all of them at the end of the year, and we are now preparing the consolidated financial statements, that goods you have not sold, which I sold to you, includes profit and the cost. But you know that inventory should be carried at lower of cost or net realizable value. Now, if we allow your inventory and add it to my inventory, it means we are overstating the inventory because you've not sold it, hence you've not earned the profit yet in relation to that. So on that unsold goods that I sold to you that you hadn't sold or you hadn't utilized yet, we need to calculate the provision for unrealized profit on that. Now, when it comes to the treatment of provision for unrealized profit, how do we go about it? The double entry for the provision for unrealized profit is that we're going to be debiting the cost of sales. Follow me carefully. We debit cost of sales or group retained earnings, and we will credit inventory. Follow me carefully here, please. Follow me carefully here. With debit cost of sales, it means we will add the provision for unrealized profit to cost of sales. Are you getting it? That is done if we are preparing the consolidated statement of profit or loss. But if we are preparing the consolidated statement of financial position, then the unrealized profit will be deducted from group retained earnings if the parent was the one selling. But if the subsidiary was the one selling, then it will be deducted from the retained earnings for the year ended or the reporting date of the subsidiary. Does it make sense? You see a lot of principles here. Very interesting. Then we crediting revenue because, like I told you earlier, we credit inventory because, like I told you earlier, the inventory you have in your stock contains a profit component. For that reason, we need to now deduct that provision for unrealized profit in the statement of financial position. So when we bring the parent inventory, the subsidiaries inventory, we will subtract the provision for unrealized profit on that in relation to that. But remember, if we are preparing the consolidated statement of profit or loss, then the provision for unrealized figure is added back to cost of sales. The same thing happens to excess depreciation, is also added to cost of sales in relation to that. Now, if we are preparing the consolidated statement of financial position and the parent is the one selling to the subsidiary, then the provision for realized profit will go to group retained earnings. But if the subsidiary is the one selling to the parent company, then the provision for realized profit will go to the net assets the year ended, or we subtract it from the profit for the year of the subsidiary in relation to that. Any questions, please? So number one, note the treatment of the total sales figure. Number two, note the treatment of the provision for unrealized profit. But this is the third aspect that you got to understand. It's what is called the current account. So let me take you through that. So when we say the current account, what do we mean? And I'm going to make an assumption here, like a parent selling to the sub, so that I can use that in relation to that. Richard Opoku Ajiman said, please go over the share premium. Share premium? Where? Are you talking about share premium we looked at under the share exchange earlier? Hey, wait. Okay, let me talk about that real quick. We said that, I don't know, Richard, is it about the share premium in relation to the share exchange? Is that what you're talking about that we did under fair value of consideration transferred? Because that would be really taking us back. But this is the idea. If there is a share exchange and the share price is 2.5, we said that you look at the nominal value. If the nominal value is 1, that means the profit on the issue is 1.5. So the 1 goes to the share capital account, and then the 1.5 goes to the share premium account. And we multiply these respectively by the number of shares that has been issued by the company under the share exchange in relation to that. So if that was what you were asking, that's it. Now, let's look at the current account, the third aspect. And I'm going to drop a bomb here, so make sure you stay with me closely. Stay with me closely here. There is going to be a current account if at the end of the day, someone is owing someone. So I'm going to use an illustration like I told you earlier. We're going to be assuming that the parent sells to the subsidiary, okay? So it makes our analysis very simple. If the parent is selling to the subsidiary, what's happening here? It means that, and the subsidiary has not paid, what it means is that in the parent's books, as part of their receivables, we have there the amount the subsidiary owes them. Does it make sense? If the parent sells to the subsidiary and the subsidiary hasn't finished paying it, that means that at the reporting date, as part of the trade receivables of the parent company, there is an amount of the subsidiary, or there is an amount that the subsidiary owes the parent. So in the parent books, we're going to be having trade receivables. In the subsidiaries books, as part of their trade payable, they are going to have the amounts they owe the parent. So in the subsidiaries book, they are going to have trade payables. But remember what we mentioned in the beginning, that we need to eliminate any intragroup trading and any intragroup debt. Any intragroup debt. So how much the parent owes, how much the subsidiary owes the parent has to be cancelled out. So when we go to the consolidated statement of financial position and we write trade receivables, and we bring the parent's trade receivables, we bring the subsidiary trade receivables, we must subtract how much the subsidiary owes the parent. Then when we write payables, we bring the parent's payables, the subsidiary's payables, we must subtract how much the subsidiary is going to be paying to the parent in relation to that. That way, we have canceled the intragroup trading in relation to that. Okay, Pawile, I see you. You're welcome. Now, sometimes the figures will not be the same. Listen to this carefully. So in the books of the parents, they know that they are going to be receiving $20,000 from the subsidiary. In other words, the subsidiary owes them $20,000. But in the subsidiary's book, they also have that they owe the parent maybe $8,500. So the question is, why from the discrepancy? What is the reason? Why is it that the parent's figure is different from the subsidiary's figure? Why? What's going on? All right. What is going on is that there could be two reasons why there is a discrepancy in this figure. Number one is what is called goods in transit. Now, it could mean that since the parent is selling to the subsidiary, the parent has dispatched some goods to the subsidiary, but as at the reporting date, the subsidiary hadn't received the goods yet. What it means is that to the parents, they have sold, so it is included in their trade payables, sorry, in their trade receivables. But because the subsidiary hadn't received it, it is not included in their trade payables there. So how do we deal with the goods in transit? The standard states that with the goods in transit, we force it into the account of the person supposed to receive it. So when we go to the statement of financial position, we bring the parents under inventory, we bring the parent inventory, we bring the subsidiaries inventory, then we add the goods in transit. And this is where I want you to be careful. The goods in transit hasn't been sold yet by the subsidiary. For that reason, we have to calculate provision for unrealized profit on the goods in transit. I hope you're getting it, because it's part of the closing stock in relation to that. So it means that when we are dealing with provision for unrealized profit, it is normally computed on two things. The first one is the closing stock, that is the stock that the company has that it hasn't sold. And the second one is what? Goods in transit. Let me put that one there. So closing stock, and then the second one is goods in transit, GIT. So that goods in transit will be added to inventory, but we must calculate what? Provision for unrealized profit on it. The second reason why there could be a discrepancy on the current account is the brother of goods in transit, and that is cash in transit. Cash in transit. Cash in transit has the behavior of goods in transit. Now, what do we mean by that? What it means is that, what it means generally simply is that the subsidiary had issued a check or issued payment for the amount they owe to the parent. But as at the reporting date, the parent hadn't received it. So how do we deal with cash in transit? We push it into the account of the person supposed to receive it. So when we write the cash on the face of the statement of financial position, what do? We bring the parent's cash, the subsidiary's cash, then we add the cash in transit as well. This is how we deal with the treatment. These are two critical items. You must know their treatment very well. So depending on, so there are some questions where only one of them will be there. There are some questions the two will be there. There are some questions none of them will be there. Okay, so you just have to know the treatment in relation to that. So let's assume that in my illustration here of receivables in the parent company, $20,000, and then payables in the subsidiary company, $8,500, is due to cash in transit. So if it is due to cash in transit, then we will force the cash into the account of the parent. So we will reduce the parent's 20,000 by the cash in transit, and that is going to be 20,800. I think that should give you 11,500. So it means the cash in transit is 11,500. So we will force that into the books of the parent company. And then now, when we write receivables, we bring the parent receivables, the subsidiaries receivables, we will deduct 8,500. Then when we write the payables, we bring the parents payables, we bring the subsidiaries payables, then we will deduct what? 8,500 as well. So if there is a cash in transit, that's how we would have done the treatment. If it was a goods in transit, remember what I said, we push it into the account of the one supposed to receive it. So in that case, we add it to inventory. So if we are adding it to inventory, that means that we do the treatment as well in relation to that. This is how we deal with intra-group trading. Any questions? Any questions? So I see a comment from Womame Godwin. He said, God bless you, sir. Amen. God bless you too, Godwin. Any other questions? Everybody okay on the intragroup trading? Everybody okay? Okay. Now, the final thing I want to talk about this intragroup trading thing is the calculation of the provision for unrealized profits. How do we calculate it? Because sometimes they will tell you that goods are sold at a margin of 20%. Goods are sold at a markup of 20%. So how do you really arrive at the provision for unrealized profit? So let me go through this with you in relation to how we go about the treatment. Then a comment coming from Mojela. If I don't pronounce your name well, please forgive me, okay? Mojela said, thank you so much. This is so helpful from South Africa. Okay, Mojela, you are welcome. And much love to you as well from South Africa. So from Ghana to South Africa, right? So let's look at how we calculate the provision for unrealized profit. So let me clean this side of my board. Now, when it comes to calculation of the provision for unrealized profit, I want you to keep it simple. So let's keep it simple. There is a KG2 way of calculating the provision for unrealized profit. You see, when we were in KG2, we were taught how to calculate the provision for unrealized profit. I don't know the school, that's the KG2 school that will be teaching this, but that was how I learned it. So KG2 method. KG2, I've written K2. So KG2 method of calculating provision for realized profit. Okay, I see a comment coming from Basil Akan. He said, please, at what value is the goods in transit, or at what value is the goods in transit? Cost or net realizable value? It has to all, we will just add the total amount to the inventory, then we'll deduct provision for unrealized profit. Basil, that is the treatment. So it doesn't matter what value is this, we just add it to it. If it is at cost already, good news, we just add it to it. But if it is at margin, then we add it and then we'll subtract the provision for unrealized profit in relation to that. But chances are it's always including the value, the selling value. So you just add it to the inventory, then you subtract your provision for unrealized profit. So it doesn't matter whether it should be at cost or realizable value. It has to always be the value minus the unrealized profit. Okay, thank you. You are welcome. So look at the KG2 way of calculating the provision for realized profit. When I finish with the KG2, I'll show you the professional way as well. Then the one that you stay with will help you. But I know the KG2, you will never miss it. So once you understand the KG2 method, like you will love it, right? That is why it's KG2, because as children, they have to make the thing simple for us. Do you get it? I'm a KG2 student, that is why. Okay, so let's go. So let's say that the parent sells to the subsidiary. So parent sells to the subsidiary. So let's say that the value of the sales is how much? So the sales was, let's say $2,000, and they made the sale at a margin of 25%. Now, from your cost accounting class or management accounting class, you know that margin is on sales, and then what? Cost or markup is on cost. So if it is direct like this, I don't have to think. All I do is that, okay, provision for unrealized profit is simply going to be equal to 2,000 by 25%. So 2,000 by 4, that is going to give me 500. So this will be my provision for unrealized profit. It's straight, no magic. Another scenario is, let's say that the sales that they made had a cost of $8,000, and they made the sales at a markup, let's say 20%. So if they made the sale at a markup of 20% on cost, that means if we are looking for our unrealized profit, again, we don't have to think here, we just go straight up. I'm coming to where we won't go straight. That is where my KG2 and the professional concept comes in. So if it is the second scenario, then the provision for unrealized profit will be equal to $8,000 times 20%. So 8 divided by 5, 1,006. So 1,600. That's the provision for realized profit. So if you have the sales value and the margin, It is direct. If you have the cost and the markup, it is direct. But this is what the examiner is going to be doing in the exam hall. He may not go direct like this. He may go the other way around. So the other way around is where you have to decide how you can determine your provision for realized profit. So look at it. If we are going to the other way around, remember the parent is still selling to the sub. The sales value is given to us, and that is, say, $18,000. And then we are told that the sales was made at a markup of 20%. So the question we ask ourselves is, markup should be on cost, but we don't have the cost. What we have is the selling price. So how do we get our provision for realized profit? Like I said, we have the KG2 method, we have the professional method. Let me go to the KG2 approach in relation to that. With the KG2 method, we learned that in the KG2 class, we learned that selling price equals cost plus what? Profit. Remember this, right? We learned this in KG2. In this question, you realize that we have the selling price at 18,000 or as 18,000. We don't have the cost. So the cost will be X, and we are giving markup of 20%, and so that will be plus 0.2X. So we're going to have 18,000 equals 1.2X. So we divide both sides by 1.2, divide both sides by 1.2. So your X, which is the cost, will become 18,000 divided by 1.2. And that's going to be 15,000. So if your cost is 15,000, that means your provision for realized profit will be $3,000. Makes sense? That is the 18,000 minus the 15,000 in relation to that. That is the provision for unrealized profit in that case. This is the KG2 formula. It will never make sense. But if you want to go the professional way, all we do is that if you are giving markup and you have the selling price, you add the percentage back to 100. So let me put that here for you. And you can choose which one to go with, okay? Whether the KG method or the professional method, okay? You can decide based on your understanding. So we have the sales, but we are giving markup. To get our provision for realized profit, it will be the percentage given to us over 100 plus the markup. So let me make it simple. The X is the percentage given to us. We do 100 plus X, and then we multiply it by the sales. So if I should apply that formula here, it will be 20 over 100 plus 20 times 18,000. And that will still give us 3,000. So you have to choose whether you go by the KG2 method or you go by the professional method. So the reverse is true. Any questions, please? So if, for instance, we are giving the cost of the goods we sold, okay, we're giving the cost for the goods we sold. Clayton said, KG2 looks simple. Yeah. KG2 is always simple. It never fails us. You know that, right? Sometimes with the professional approach, you are thinking, should I add or should I subtract? With a KG2, you don't have to think about that. You just go straight up and you don't mix. So Clayton, that is true. So the reverse is true. So if we have the cost, but the examiner gives us markup, how do we go about it? In the KG2 class, we can do that. And then in the professional class also, we can do that. Does it make sense? So let's go using the same scenario. Let's say we have the cost and we are given margin. That way, how do we go about it? Any comments or any questions, put it in the chat box. So now we have cost, but we have margin. So look at it. Here we don't know the selling price. So the selling price will be X, but the cost is 18,000. So our profit is going to be 0.2 X. So what's going to happen? We're going to have X minus 0.2X equals 18,000. Now, X minus 0.2, you know the coefficient of every variable is 1. So that would be 0.8X equals 18,000. We divide both sides by 0.8. We divide both sides by 0.8. So the X will be equal to 18,000 divided by 0.8. That is 22,500. So this becomes my selling price. Okay. Then in that case, my provision for unrealized profit will be the 22,500 minus 18,000, and that is going to be $4,500. So in the KG2 class, if I'm giving the cost, but I'm also giving margin, this is how I determine my provision for unrealized profit. But if I'm doing the professional, I want to be professional, then we change it up. So we have the cost, but this time around we have margin. So what do? We're going to be deducting. So it's going to be 100 minus the X multiplied by the cost price or the cost of the inventory. So if we are going by that approach, clean everything up here, it's going to be 20 divided by 100 minus 20 multiplied by the cost price, 18,000. And so that is going to give us 20 over 80 times 18,000. It should give us the same 4,500. There you go. So the choice is yours. You can decide. I understand it. I want to go with a professional approach. I'm not fighting with you. You can also say that, okay, in order for me not to think whether to deduct or subtract, let me just go with my KG2 approach. One thing I know is that KG2 never disappoints, because with KG2, all I do is I code my formula, and then whatever I have, I substitute it into it. Whatever I don't have, I use it as X, and I get my answer in relation to that. So this is how we also calculate the provision for unrealized profit. So KG2, professional, choose. Let me know in the chat box which one is okay for you guys, or which one do you guys use very often. I think Cletus said the KG2 looks simple. So let me know in the chat box which one is okay with you or that you will be using. Let me know in the chat box. So that is the idea about the intragroup trading. Okay, so you realize that in the intragroup trading, in a nutshell, we're dealing with three broad issues. Number one, the total sales. Number two, the provision for unrealized profit. Number three, the current account. In dealing with the current account, we can have goods in transit, we can have cash in transit. Remember that anytime there is goods in transit, you have to look at the issue in relation to provision for unrealized profit on the goods that is in transit. Emmanuel Addison said, please, does it depend on who is selling, whether parent or sub? No. Calculation of provision for unrealized profit, it depends. No matter who is selling, the provision for realized profit will be calculated. It is the treatment that will be dependent on who is selling. So the provision for realized profit, if it is the subsidiary selling, then the provision for realized profit will be deducted from the parent's net asset, sorry, from the subsidiary's net asset for the year ended, or we will deduct it from their profit. Are you getting it? But if it is the parent that is selling, then the provision for realized profit will be deducted from the group retained earnings. Either case, when the parent is selling, remember it will also be added to the state cost of sales if you are preparing the profit or loss account by the parent, if the parent is selling, and if the subsidiary too is selling. So the calculation doesn't change. It is the treatment that varies based on who is selling, so that the treatment will appear in their account in relation to that. Janedu said, KG2 is new to me, but very simple. All right, John. So that is KG2. You know, KG2 there, we are children, so our minds is not hard. So they have to make things very simple for us. So that's why I love KG2. KG2 will never mess me up, you know. All right. So now we've dealt with the principles, we've dealt with the intragroup trading. Let's go to the final two principles about that. Jonas said, professional method is soft. The hint is knowing margin or markup. Yeah, certainly, certainly. You need to know the margin and markup and know when to add, when to subtract, and know what you are going to be multiplying at the end of the day. So that is the idea in relation to that. So let's look at group retained earnings and then the NCI value at the reporting date. Emmanuel Addison said, yeah, but sometimes it's difficult to tell whether the sales is at cost or margin. If you read a question well, you will know if it is at cost or it's at margin, because it will be stated in the question. Okay, to be stated in the question. And tomorrow we'll be solving a consolidated question in relation to that, where I'll be dealing with some of these languages for you guys. So tomorrow we will be continuing with this, and this time around we'll be practicing a question. So most of these languages, you will see them, and then you will know how to treat them in relation to that. So let's look at the next workings, and that is going to be group retained earnings, or what is called the consolidated retained earnings. So when it comes to the consolidated retained earnings, what comes? As always, we bring the parents' retained earnings. It's brought. Then share of subsidiaries post acquisition profit or loss. If it's a profit, we add. If it's a loss, we deduct. Then share of associates post acquisition profit or loss. If it's a profit, we add. If it's a loss, we deduct. Then remember I told you the unwinding on the deferred payment, and then finance costs on the loan issue. If there is anything like that in the question, it comes here, deducted. Then if there is any impairment, could be brought in relation to that. Now, impairment on our investment or impairment in the subsidiary in relation to that could be brought. Other times, impairments could also be allocated between the parent and then the subsidiary in relation to that. Then if the parent was the one selling, then we'll bring provision for realized profit. Yeah. That is, if the parent is the one selling in relation to that. So we bring the parent's retained earnings, we bring the share of post-acquisition profit or loss, share of post-acquisition profit or loss of the associate as well, finance costs on the deferred payment and the loan issue, impairment on investment in associate as well as subsidiary, provision for unrealized profit will be brought as well in relation to that. Then any other item that could be in the question relate exclusive to the parent could also be brought. So when we add all that up, that gives us the group retained earnings, which is taken to the statement of financial position under equity. So that's how we deal with the group retained earnings. So once we deal with the group retained earnings, the final thing is to look at, John Edu said impairment parent portion. Yes, like I mentioned, sometimes it will be allocated. So the parent portion will be brought here in relation to that. Other times it could be charged fully to the parent in relation to that, and that is also correct in that case. So there are times when it will be allocated between the parent and the sub. So in that case, you will even see the impairment in the net asset of the subsidiary. So we deduct it from the year-end profit, meaning that like we've already adjusted it in the post-acquisition profit. So we will not even see the impairment again coming on the group retained earnings or coming on the year ended or the reporting date figure for the NCI in relation to that. Emmanuel Addison said, please, also negative goodwill can also feature in retained earnings. Yes. There is a negative goodwill, meaning it's a profit on acquisition. Okay, so when there is a negative goodwill, it means it's a profit on acquisition. What do we mean by that? Meaning that, for instance, you paid $20,000 for the company, but the net asset of the company is actually $22,000. Meaning you've paid less than the net asset. So that $2,000 becomes a gain on the acquisition. And that gain on acquisition will come as part of your group retained earnings. So yes, that will be brought in relation to that. Emmanuel Addison said, and with the impairment too, if the question is silent, do you share between the parents and the sub? It depends. You can share, it's allowable, and you can decide not to share, it's also allowable. As far as the entity has control of the company, there are times when impairments will just be carried by the parent company as a whole. So you can decide to share, even if the question is silent, or allocate all to the parent company in relation to that. It will still going to be correct in that case. So that is how we deal with our group retained earnings. Any other questions? Okay. So after the group retained earnings, the final thing we do as part of our workings is the non-controlling interest at the reporting date. Non-controlling interest at the reporting date. Now remember, you will do this workings, that is, you will calculate the group retained earnings if you calculate a group retained earning only when you are required to prepare the group statement of financial position or the consolidated financial position. So if you are required to prepare consolidated financial position, that's when you do these workings. If you are preparing the consolidated statement of profit or loss, there is no need for you to do any workings for the group retained earnings. So it's also something you have to take note of in relation to that. Then Jonas said, sometimes there is a word reserve. What about under Group retained earnings. Jonas, I don't get your question. Reserves are reserves. Now, so sometimes reserve can be treated, if there is reserve and there is no retained earnings, then the reserves will be taken as the retained earnings and will be brought in the group retained earnings. But if we have reserves and we have group retained earnings, then that reserve doesn't come here. It goes straight on the face of the statement of financial position in relation to that, because it could be a revaluation reserves or any other form of reserve like unrealized or gain from issue of compound financial instruments upon the date of conversion. So if we have reserve and we have retained earnings, then the reserve will be brought as a separate item on the face of the statement of financial position. But if we have just reserve without retained earnings, then in that case, we are going to be taking the reserves the same as, or as being the same as the retained earnings in relation to that. So Jonas, I believe you are okay with that. Okay, so let's look at the final one. Value of the non-controlling interest at the reporting date. Okay, so final thing, non-controlling interest at the reporting date. Okay. So what do we bring? Very simple. We'll bring the NCI at acquisition. Remember, we did the workings for this when we're computing the goodwill. So that same figure will be brought here. Then you bring their share of post-acquisition profit or loss of the subsidiary. If it's a profit, you add. If it's a loss, you deduct it. Then in case you are apportioning the impairment and you hadn't taken it into consideration in the determination of the post-acquisition profit, then you bring it up here by deducting it. So this gives us the non-controlling interest at the reporting date, which goes under equity in the statement of financial position. So this is also what we do when it comes to the non-controlling interest value at the reporting date. So when it comes to the treatment of consolidated financial statements, these are the workings we go through. Remember what I said. When answering consolidated financial statement questions, don't rush put your pro forma financial statement down. You won't get anything for that. Spend time. So you spend time, then from there, you'll be able to now prepare the financial statement. So that is one thing you have to take into consideration, and you need to take note. Hello? Okay. Guess my sound was breaking a little bit. Is it okay now? Hello? Hello? Okay. Yes, John, I realized that my network is dancing, so that's why my sound is getting poor. Are we good now? Like, can you hear me now? Hello? We good now? Can you hear me now? Let me know if you can hear me now. I think the sound is a bit okay now. Can you hear me now? Okay, so I guess the sound is a bit okay now. So that is the principles about the things you need to understand when it comes to consolidated financial statement. So God willing, tomorrow we're going to be looking at a full consolidated question to see how we put all of these principles actually in practice and see the languages that may be in the question, and I'll be directing you on how the workings will be done. Remember, I told you that you don't read the whole question. You read the question bit by bit, because if you read the whole question, by the time you finish reading the whole question, like your head will just start going off in relation to that. So God willing, tomorrow, we're going to be solving a practical question tomorrow. So practical question to be solved tomorrow. I'm seeing a comment coming up. But it looks like it's been covered a little bit. Right, so I'm seeing some comments. Let me. So let me answer a couple of your comments real quick before I sign off. Emmanuel Addison said, please, can you explain the issue of cum-div and ex-div both at pre-acquisition and post-acquisition? Now, if you want to know about the issue about cum-div or ex-div, cum-div simply means that when you buy the shares at the cum-div price, it means when the company pay dividend this year, it means you are going to be getting the dividend in relation to that. That is the issue about the cum-div. And then ex-div simply means that for this year, that the company has already paid dividend, and so you will not be receiving dividend if you buy the shares now. What happens is that the cum-div share price is always greater than the ex-div share price in relation to that, because the cum-div means you'll be receiving dividends now. Should we pay dividend? Ex-div means you will not be receiving any dividend in relation to that. Then Andrew Oponbeko said, please, at what times will we be asked to value NCI at fair value, and at times to, please, at times to, we will be asked to value. Yes, for the valuation of the NCI, it depends on the question. It can be either as a proportion of the net assets, or as a proportion of the, or as a, at fair value using the share price of the company, or the directors of the parent will determine the value in relation to that. Then Richard Opoku Ajiman said, please, fair value as a proportion, rather is percentage of NCI at reporting date. No, please, you don't do that. Fair value as a proportion of net asset is always the net asset at the date of acquisition. So please take note of that. Sir, please, I think when calculating the NCI, percentage proportion is rather the NCI portion multiplied by the date of reporting, not acquisition. No, it's not the date of reporting, it's the date of acquisition. Please take note of that. If we are valuing NCI at the date of acquisition. So, Richard Opoku, it's the net asset at acquisition, not at year end or not at the reporting date. Please take note of that. If you are calculating goodwill at the date of acquisition, when you are valuing NCI as a proportion of net asset, it is the net asset at acquisition, not at the reporting date. Please take note of that and correct yourself. So thank you guys for joining the stream today. Mustafa, Emmanuel, Ebenezer, Enoch, Andrew, Cletus, Richard, John, Jonas, Richard Amegashi, Xavier, Tamba, John, Avoca, Gettysburg, Livsda, Miriam, Mojela, Godwin, all of you guys, Jonas, everybody, Cletos, everybody. Thank you very much for taking time to join the stream today. It's always a privilege to come your way and explain these things to you and answer your questions as well, to assist you in order for you to prepare well for your 4:30 p.m. as we solve a practical question on consolidated financial statements and how we put all of these principles together. So take care of yourself, and I'll see you same time tomorrow, 16:30 GMT or 4:30 p.m. in relation to that 4:30 p.m. Ghana time. All right, Jonas, take care of yourself as well. Remember, coronavirus is still around. So as always, make sure you wear your nose mask, wash your hand, keep social distancing, sanitize your hand regularly, and just stay safe and keep on working, keep on believing in God, and keep on studying. That's very important. I'll see you same time tomorrow. Bye-bye.